Major update for the Employee Provident Fund. Sources at NDTV have picked up that there is a major decision that is underway and that is soon to be taken by the Ministry of Labour, and that relates to inoperative accounts with deposits of 1,000 rupees or less. And this is, I know, not going to be a very large portion, but then directionally it means that the government and the EPFO as a body are looking to return the money of all of these inoperative accounts. What it says is that there are 600,000 inoperative accounts with deposits of less than 1,000 rupees, and the money will be deposited immediately in those that are linked to Aadhaar, and the remaining accounts will be distributed gradually. A total of 600 crore rupees is accumulated in that. So it's quite a substantial sum of money that will be returned. Bear in mind that if you do have investment in the EPFO, that you should track it on an ongoing basis by getting a login to that EPFO website. It's something that you should track. But speaking of tax-free returns, I thought it's a nice conversation to have. EPFO exists, of course, the Employee Provident Fund exists, but what else do you have? And what are the factors that you need to bear in mind? Joining me today is Abhishek Mehta in studio. Abhishek, thanks so much for taking the time.
Thank you, Alex.
Specifically on EPFO, there are a few fallacies that people have, and
yes,
we've tried to correct some of those on this program as well.
Right.
One of them is that all investments in the EPFO and into the Employee Provident Fund are tax-free. That's not true, right?
That is not true, yes. So there has been some changes in that. So there are two types of contribution which goes into the EPF. One is your employer contribution, another is employee contribution. Let's break it down, both of them, and take it up one by one. In terms of employer contribution, 12% of basic and DA is tax-free. The only caveat is the maximum amount which is allowed now is 7.5 lakh. So your EPF, your NPS plus your superannuation, everything put together in a year can be maximum up to 7.5 lakh. So the employer, what he is contributing to your EPF doesn't becomes part of your income up to 7.5 lakh or 12% of basic and DA.
And anything above that
becomes taxable. That will considered as your perquisite.
Correct.
Right.
And the interest on that becomes taxable.
That's also become taxable. In terms of employee contribution, now if you are in old regime, you can claim ATC, which is 1.5 lakh up to that amount. And if your contribution is more than 2.5 lakh, your personal contribution towards the EPF is more than 2.5 lakh, even the interest on that additional amount becomes taxable.
Sure.
Up to 2.5 lakh, the interest is tax-free, but over and above 2.5 lakh, the interest also becomes taxable.
Because that means that your employer is also contributing 2.5 lakh.
Yes.
The total contribution is crossed at 5 lakh.
Yes, yes. So that is one thing. One very important thing is when you redeem this money, whenever you get to your retirement, most of it is, the entire amount is tax-free.
Right.
But a lot of time what happens if you take a break from your employment and there is a less than 5 years of continuous service, then the entire amount what your employer has contributed in the last 5 years, or if you have left the job on the 3rd year, the entire amount will get taxed. The entire interest, which was tax-free for the last 3 years, will get taxed. Third, whatever employee contribution you have done, and if you have claimed it under Section 80C, that will also get taxed.
Wow.
So before leaving your job, you have to ensure that did you had a full 5 years of continuous service, and if no, then plan your taxes well in advance.
So let me understand this. In a hypothetical scenario, you worked from 2015 to 2019.
Yes.
You had a break for 2 years.
Yes.
And then you started in 2021 or 22, and you worked till 25. That means that you've not had continuous service.
No,
right?
not continuous. So in 2020, when you left your job, or probably 2019, in the next 6 months, if you don't get a job, then you have to pay the taxation on the entire amount. So there is a 6 months window. If there is
even
more
if you've
than,
not redeemed it.
even if you are not redeemed it, you will have to pay the tax, because the Act says that you have to be 5 years of continuous service. And if there is a break, so a lot of time, that is why when people are going for a career break, we advise them to plan their things properly, because a lot of time if you have just completed 4.5 years, better you complete another 6 months and then take a career break in your life, so that this entire 5 years amount doesn't get taxable. And all three things get taxable: employee contribution, employer contribution, plus the interest of the last 5 years.
This is in the EPFO Act.
Yes, right.
Okay, so that's something to bear in mind. What
Right.
else in the way of tax-free returns are still relevant and should be considered actively today?
One is, a lot of people, like Nirmala Sitharaman said yesterday, only banks are, selling insurance more. Mis-selling insurance more rather than, concentrating on the banking operations. Very important points on the insurance. The insurance proceeds are tax-free. Okay, but few things which you have to bear in mind is, one, if you have taken a guaranteed income plan, okay, if you have taken a pure term plan, I have taken a 2 crore pure term plan, then the entire 2 crore is tax-free on my death. But if I have taken a guaranteed, income plan, the insurance plan,
the way of traditional
policies, then if I am paying a premium of more than 5 lakh rupees, then that amount becomes taxable. Okay, so premium up to 5 lakh is allowed. Anything if you pay over and above 5 lakhs in a year. So suppose I took a 4 lakh policy last year. This year I took a 2 lakh rupees policy. Then this 2 lakh policy, whatever proceeds will come, I will have to pay tax.
Oh, okay.
Okay, so 5
it's
lakh
an incremental thing.
Incremental thing, right. Second, if you have taken a ULIP policy, only up to 2.5 lakh rupees of premium paid in a year is tax-free.
Okay.
Now, one thing you have to bear in mind is, if suppose I have taken a policy of 5 lakh, I cannot disproportionate it saying the first 2.5 lakh is tax-free and the next 2.5 lakh is. If I have taken a single policy of 5 lakh, the entire amount will become taxable. So that is why a lot of time then people break and take two policies. So better you take two policies, but if you take a single policy, you cannot come and say, ki Abhishek, 2.5 lakh was tax-free, then I will pay only on the remaining 2.5 lakh. So you have to bear this in mind, because banks are really pushing these products a lot.
Yeah, and of course you should think about the right fit for you. Ask yourself whether this is a product that you absolutely need, because in the investment space there are a lot of options available to you. Beyond that, there is of course the Public Provident Fund, there is the Sukanya Samriddhi scheme.
Yes.
What do you need to bear in mind?
I think Sukanya Samruddhi scheme is a very good scheme, because it is one of the highest interest right now. 8.2% is the interest which you get on Sukanya Samruddhi. So it's basically for girl child. If your girl child is below 10, you can open a Sukanya Samruddhi account. You can put 1.5 lakh rupees every year. Now this amount, how can you withdraw this, which will be tax-free? At the age of 18 of your child, you can withdraw 50% of the amount, or for the education or for the marriage. Okay, in these three circumstances, you can redeem the amount before completing 21 years.
Okay.
Or the maturity of this proceeds is basically, once I have opened the account, I have to keep it for 21 years. Premature withdrawal is allowed, that also tax-free. Conditional, but at the age of 18, I can redeem 50% of the amount without any reason, or I have to have either of the reason, which is marriage or further studies. That in these cases also the entire amount is tax-free, and 8.2% tax-free is a very good interest income what you can earn.
Public Provident Fund.
Public Provident Fund, again 1.5 lakh rupees every year you can put. That will get you an ATC benefit of 1.5 lakh. The interest is tax-free, and even the redemption is tax-free. The age of the account is about 15 years, and you can extend it by 5 years 2 times more. So you can have a PPF account for a total of 25 years in your entire journey.
And it's tax-free.
And it is tax-free. The interest income right now which is coming is about 7.1%.
Which is pretty low.
Which is little low. Better is Sukanya Samruddhi or even your senior citizen schemes, which is 8.2%. But that the interest is taxable in that.
And it's also not compounding.
It's not compounding, because that interest comes to your bank account.
Sure.
So the amount doesn't get compounded. But again, 8.2% that is taxable. Sukanya Samruddhi 8.2% non-taxable. PPF 7.1% non-taxable.
Okay, so it's interesting. I think we've covered quite a bit of ground. And of course, there's the standard agricultural income, which is non-taxable, but you need to be able to prove that you have agricultural income. It cannot be
you need to have a land. Income tax department nowadays checks Google images to check whether that land actually was cultivated and the products were sold. They ask for receipts of that mandi where the products were sold. So it's not that easy to, say that I had some agriculture income which was tax-free.
I'm growing cabbages
Yes.
in my backyard. On that note, Abhishek, thanks so much for taking the time. Pleasure
Thank you.
speaking with you.
Thank you, Alex.
Well, you might want to grow cabbages in your backyard for what you can make with it, but you can't sell it and claim that it's agricultural income. There's lots more that we've got lined up for you over the course of this evening. Do stay tuned. This is NDTV Profit.